Welcome to Frank Wealth Insights, a financial and investment podcast from Return on Life Wealth Partners. They look at your money. We look at your life at returnonlifewealth.com.
Happy autumn. I'm Frank Fantozzi, president and founder of Return on Life Wealth Partners. It's hard to believe it's been just over a year since we launched our first podcast. Time really flies. With Thanksgiving just ahead of us, it's a wonderful opportunity to reflect on what we are grateful for. I'd like to thank all of you, our clients and friends and listeners, for tuning in and engaging with our topics over the past year. In keeping with the spirit of gratitude, I'm excited again to welcome back our guest and colleague, wealth advisor Chelsea Hussey, who will discuss with me on how to navigate employee benefit coverages, as that's really the big time of year, what usually goes on and first and foremost on everyone's mind in November. So welcome back, Chelsea. How you doing?
Doing well. How are you, Frank?
Good. Survived survived Halloween, survived an election.
Yep.
So glad that the political ads are just done with so I can watch normal commercials for a change. I'm excited to dive in with you. So we're going to talk about your benefit packages and the various components of those benefit packages. And we're going to start out with probably the most prominent portion of that, which is your health insurance. We focus again a lot on your financial well-being, but your health insurance is really focused on your physical and mental health being. So we want to make sure that there's the right program for you given what your employer offers. So with that, Chelsea, what are your thoughts on how to kick this off?
Well, I think understanding your medical benefits are extremely important because, like you said, it integrates with your entire financial plan, and you've got a lot of different factors to consider. Your age, your health, your family's needs, your budget. All of that is really crucial, and it's pretty timely.
Yeah, we'll definitely agree. So, for example, if you're young and very healthy, plans that probably offer a higher deductible and a lower cost are probably better suited to someone to consider versus someone who has health challenges, goes to the doctor frequently, and a high deductible plan might be more cost prohibitive. And, as an overlay, I always like to share kind of the business behind some of this. With health insurance or just any type of insurance, I think individuals need to realize that the more risk and more liability an insurance company is going to take, whether it's health insurance, property and casualty insurance, disability insurance, the premium will be more. So I think the focus today when we go through at least the medical portion and the disability and life insurance portion is to understand your potential risk, and based on the offerings of your employer, especially if they offer more than one program, which program might be better suited for you?
Yeah, I think that's incredibly important.
Let's start with, and these are all acronyms. I think we all get dizzy with acronyms. So the first one we're going to talk about is Health Maintenance Organization, or commonly known as an HMO. The structure of an HMO is they offer care through a network of doctors, hospitals, and specialists. And there's always a primary care physician, which they call a PCP, that manages your patient care and provides referrals within that network. So usually with this type of program, there's a lower cost, but there's a trade-off. There's limited choice in healthcare providers. Usually it requires referrals to see specialists. So again, this type of program is probably more suited for individuals who prefer a coordinated, managed care, don't mind the restrictions on the provider choice, and can live within the network. So your premiums will be lower. The trade-off is you have to work within the limitations. So you have to decide, given yourself, again, if you're someone who's maybe younger, doesn't have a lot of health issues, and you don't worry about having all these specialists and referrals, an HMO might be right up your alley versus someone who has a very deep relationship with certain hospitals or doctors, and it's important that they're in their network. An HMO might not be an appropriate fit for you. What would you like to talk about a PPO? Why don't you discuss that a little bit, Chelsea?
Sure. So with a PPO, you have a larger network of providers, and it doesn't require referrals for specialists. Members can see out-of-network providers, but they may pay a little bit more for doing so. One of the advantages to a PPO is really the flexibility. You don't need that referral to see a specialist, and you get a little bit more choice there. The downside is that this does come with a higher premium and potentially higher out-of-pocket costs compared to with HMOs. So this type of plan is ideal for someone who might want a little bit more freedom in choosing those healthcare providers and are willing to pay for that flexibility.
An important part of a PPO and some of the other programs we're going to talk about later is the insurance companies and your employer should provide you a booklet that tells you, now everything's online. I'm a little old school. I keep thinking booklets all the time. But you're able to go online and see, which hospital systems are there, which doctors participate. And you have to be careful. Your doctor might be affiliated with a hospital system, but might be independent, i.e. not an employee of the hospital. Just because the doctor works with the Cleveland Clinic doesn't mean they could be in your network just because the clinic's in your network. So it's really important in any of these programs where you have choice of doctors that you make sure that your doctors are in the network. Otherwise, you're going to have to start up new relationships with different physicians. The other next program is what they call an exclusive provider organization, or an EPO. This one kind of like a hybrid. It combines some of the components of an HMO and a PPO. They do require their members to use a network of providers, but they don't typically require referrals to see specialists. So again, because of the hybrid and working within a network, you're going to, on average, have lower premiums than a PPO. You'll have flexibility with specialist access within their network. The negative is there's really no coverage for out-of-network except in an emergency, which is typical of most of your programs. If you're out of state or it is an emergency, they usually will handle that. But if you make a choice and you had the ability to choose in-network and you choose out of, you're going to pay 100% of that. So again, this is ideal for people who want lower premiums and they're okay with limited provider network as long as they have access to specialists that they need in an emergency.
Another type is point of service, POS. That's also a type of hybrid of HMO and PPO plans. What this has in common with an HMO plan is that you've got your primary care physician who's really managing your care. So that's kind of the tie there to the HMO. The tie that makes this hybrid with PPO is that there is some flexibility with out-of-network care. However, there still is a requirement for referrals for those specialist visits. This is, again, something that's really for people who are drawn to having that primary care physician, that relationship that they've had where they want them managing that. Again, that's likely going to come with a slightly higher premium in exchange for that flexibility.
Great, thank you very much on bringing us up on that. Another, and probably the more popular program, and again, employers are looking at programs as well and what we really didn't discuss here is how much is your employer going to pay towards these programs? So this might influence your choice. There's very few companies out there that pay 100% of your medical premium. And so employers might say, listen, we're going to pay 80% of your premium, you're going to pay the 20%. And this might influence you from a budgetary standpoint. Which program is more important? Do you go to, and we'll talk about this, a high deductible health plan versus a traditional, what they call 80-20 plan, which has the most flexibility, usually a lower deductible, but a higher premium. So a couple factors here is, one, what is your employer going to pay towards that premium? Secondly, given your health, how much of the deductible are you going to use up? Again, if you're very healthy, having a high deductible plan is not going to be a big deal because you're not having a lot of out-of-pocket. So you're going to have to look at your budget and your history and how much you've spent in previous years on medical care. And yes, you could throw out the outlier like, oh, I broke my leg. Okay, well that's something that's like a one and done versus, okay, now I became a diabetic and now I have potential issues that are related to having a diabetes disease along with treating it. So all these usually have to factor in, one, potentially your out-of-pocket costs in regards to paying and meeting deductibles, as well as what the employer is going to pay. So these are things that you have to kind of budget for, look at your history, and then say, all right, what's being provided? And we always like to advocate to make sure you have the best health care that you can afford, because you never know when something happens, especially as we age. I think the secondary consideration is really to look at your history, your health, and say, okay, statistically, I have odds on my favor. I usually don't have a lot of costs with medical care, so I can take on some of that risk. But these are decisions that you have to make. And again, there's no guarantee because we don't know what our health is going to be in the upcoming 12 months. So as I was talking about, we're going to start and talk about the high deductible health plan, or they call an HDHP, throwing more acronyms out at you. So the primary difference is this is a high deductible plan with very low premiums, and they're very much tied to what they call a health savings account, or what they call an HSA, to help pay for out-of-pocket costs. So one of the primary benefits is lower premiums. They also allow HSA contributions, which we're going to talk about HSA later. It's basically a tax-deferred health savings account, and we'll talk about how that works. The con is it's a high out-of-pocket cost before the plan starts paying. It's really best suited for those that are usually younger and low health care needs. I believe the maximum out-of-pocket for a high-deductible plan in 2025 is $8,300 for individual and $16,600 for families. So you can see that's a chunk of change that you have to be mindful of if you're going to have the insurance companies start paying for any of the benefits. You're going to have to meet that maximum amount out of pocket. So that's a key program. It's very much available today and very much used. In fact, to drive people to high deductible plans, if it's offered by your employer, they usually incentivize employees because they will match a certain amount of contribution to your HSA account. It's a common way to drive people, because remember, if the employer is paying any portion of your high deductible plan and they have more people using the high deductible plan, they're also going to lower their costs. So typically employers that offer a high deductible health plan will usually offer this in combination with maybe a more traditional plan, because they realize that not everyone is best suited for an HDHP plan.
It's important to be familiar with your coverage too when you're meeting with your advisor and your advisory team, because as Frank said, understanding what your deductible is certainly guides some of your other decisions, like what's my ideal emergency fund number. If we know that we have to meet a high deductible if something unexpected happens, then that would guide how much cash you'd want to keep or how much money you'd want liquid in order to deal with that. So not only on a personal financial planning side, but then secondly, it's very important for our business owner friends and their executive teams to be familiar with these types of plans as well, because one, it's important to be able to articulate the reasons why you chose this plan if you have employees who ask, but two, being familiar helps you understand the impacts to you as their employer and the ultimate impacts to your employees.
Yeah. So since we brought up HSAs, why don't we talk about HSAs and the predecessor, which is still around, an FSA, which is a flexible spending account, and what we talked about, an HSA, which is a health savings account. They are both valuable. They're not usually offered by the company for both programs, but they do operate differently, but we want to make sure you take advantage of the benefits. So Chelsea, why don't you tell us a little bit about how an HSA works and the benefits, the flexibility and all that?
Yeah, the HSA is one of my favorite financial Swiss Army knives in that it's got the most tax advantages of really any plan. As I mentioned, these are available to people enrolled in a high deductible health plan. And as Frank mentioned, the IRS will define what counts as high deductible each year, with $16,000 being the maximum for families. With HSAs, your contributions to those are pre-tax deductions, so those reduce your taxable income. There's tax advantage number one. The annual contribution for 2025, to let you know what those limits are, for individuals, it's $4,300, and it's $8,550 for families. So that's a huge advantage of additional tax deductions. Another great advantage of HSAs is that any unused funds from those HSAs, they roll over year to year without limits. So it really gives you a great long-term saving tool. If you're a young and relatively healthy professional or family, if you're maxing out that contribution each year to get that tax deduction, you could really have a long-term health savings nest egg building for you if you're not tapping into it each year. Or if you're like me and you're already pre-planning your kids' braces a few years from now. Another key advantage of HSAs is they're portable. They're owned by the individual, so they stay with the person if they change jobs or retire. Another great advantage is the investment option. So HSA funds can be invested in mutual funds, stocks, or other assets once the balance reaches a certain threshold. So this not only allows for long-term growth year to year, but it allows you to take advantage of compounding interest and really accelerating what may be there for you. Now, as I mentioned with HSAs, they have this triple tax advantage. So you have the tax deduction up front when you contribute to it. It grows tax deferred, and then the funds in that HSA, when you withdraw those, can be used tax-free for qualified medical expenses. That is a key there, is that it must be a qualified medical expense. There's great resources online that will let you know everything that falls under that. It's a pretty wide umbrella. It is important to note, though, that if those funds are used for non-qualified expenses before age 65, that withdrawal will be subject to income tax and a 20% penalty. So certainly incentive to make sure you're not misusing those funds. Now, after 65, non-qualified withdrawals are only subject to income tax, which makes them function pretty similarly to a retirement account. I love the triple tax efficiency of an HSA plan, and for those of our clients who really aspire to that early retirement, which a lot of our clients are, this is a great way to take care of some of their healthcare needs prior to qualifying for Medicare and things like that.
Well, thanks, Chelsea, for handling the more difficult of the two. I'll tackle the flexible spending account, known as the FSA. That's been around a lot longer. It's offered by more employers, especially if there's not a high deductible plan. Again, you tend to see, to have an HSA, you have to be part of a high deductible plan. They're tied together. If you do not have that, then you end up having to use what they call an FSA if it's allowed. In its function, it's very similar in that you put pre-tax money in, so you get the tax break. The amount is a lot lower. It's $3,300 in 2025. So they are pre-tax, and they have to be used for qualified medical expenses. So in that front, very similar outside of the limit to an HSA. Where they're different, they're not portable. You can't roll them over. There's no investment options. It's a lose it if you don't use it program. So you have to kind of be mindful of your budget and say, all right, every year I tend to spend $1,500 in out-of-pocket medical expenses. If that's the case, then I'm probably going to put only $1,500 into the plan, because if I don't use it all by the end of the year, I lose it. So maxing it out for the tax deduction isn't worth it unless you have a qualified expense. So really do some budgeting, or as Chelsea said, if she was part of an FSA and she knew she had to do braces, and that was going to be something new for the year outside of your normal course of medical expenses, then you can factor that in and say, all right, I have a one-time increase this year because I'm doing braces on my child. So I add the cost of the braces to the $1,500, and I would defer up to the $3,300 limit. So that's how we would approach FSA. So you have to be a little more pragmatic and a little more cautious in regards to how you budget for that. With that, I think we covered probably the big essentials for the medical program. Again, the key takeaway is to look at what your employer is offering, look at your health and age, look at your experience with medical expenses, and factor in which program will, one, most importantly, give you the coverage you need. I think that's really always the most important. And then two, financially, which one would cost you less and still provide you with the care you need. And again, take advantage, if you're in a high deductible plan, of using HSA. Even if you don't have a lot of medical expenses and you can afford to put money into the HSA, the theory is as you get older, higher likelihood you're going to have more medical expenses. So if you can build that bank, especially as Chelsea pointed out, and invest the money and make that grow, you're going to put yourself in a much better position to deal with medical expenses in the future. So just because you're healthy and you decide to do the high deductible plan, to the extent you can afford to from a budget standpoint, really pound home the money inside of the HSA program. So with that, we're going to move to a new topic, and these are all important because they're all about managing your risk from a health standpoint. We're going to talk about short-term and long-term disability. So Chelsea, why don't you lead the way?
Sure. As far as short-term disability goes, it would be fair to say that most people are familiar with that from the Aflac commercials. That's usually when you hear short-term.
I'm not going to quack for you, though.
All right. That's usually where we tend to think short-term disability. And, the commercials do a good job of explaining it, is for the things that your health care insurance doesn't cover, or bills that are still due when you're sick or ill for a long period of time or an extended period of time. That's where short and long-term disability come into play. Now, for short-term disability, this is usually for a sickness or injury that takes you out of work for typically less than 90 days. There are some 180-day plans, but about a 3-month time frame. As far as the practical uses of short-term disability, it is something that tends to be provided to many employees. There's usually not a ton of extra cost out of a paycheck. It's certainly something for women who plan to have families. It's certainly something to consider to make sure that that's something that your employer offers. In general, and I don't know if you have a different take on this, Frank, but when it comes to buying a separate short-term disability insurance policy outside of what your employer may provide, there might not be a strong case for that if you've got a pretty competitive or healthy savings or emergency fund.
Correct. So when we talk to clients from a financial planning standpoint, Chelsea, one of the things we talk about is creating a rainy day fund, because in both disability programs will approach it the same way. They don't cover 100% of your pay. Usually your short-term disability is stated as a benefit, as a weekly benefit in relationship to your pay. But rest assured, if you look at it, first of all, there's no program out there that's going to cover 100%. The question is, giving your work class within the employer, they're going to pay a weekly stipend, and it's usually somewhere in the range of 40 to 60% of your pay. The benefit is taxable because the employer is paying it on your behalf, and I've never seen an option where on a short-term disability plan where the employee can pay for the the premium, and then have the benefit tax-free. So to be safe, having that emergency reserve of 90 to 180 days where it's not just for health reasons, it's, the furnace blew out and I got to buy a whole new furnace. So having some liquidity to deal with life's, what they call unexpected pop-ups, are where this factors into. So even with your short-term disability insurance plan, we do recommend you factor in a program to have money in a reserve, call it a rainy day fund, to deal with some of these issues.
Absolutely. Now the question then becomes, once we're past that 3 to 6 month window, what happens then if we have an extended illness or injury? And that's where long-term disability insurance comes in. Like short-term, that usually pays a percentage of your salary, often 60%, maybe 66%. If you're a teacher, it starts at 45 and then goes up. But it covers a portion of that salary, and then that can last, depending on the contract, from that 91st or 181st day all the way up through retirement or age 65. There might be other stipulations. It's really crucial, and this is something we counsel a lot of our clients on, to be very familiar with how your company's long-term disability policy is defined, because there can be certain pieces of language in that contract where you might think you got a healthy amount of coverage, but there might be some stipulations to it, like mandatory rehabilitation, where you have to be doing something in order to get that, to take care of that illness or injury, or the definition of disabled. Is it an illness or injury that prevents you from doing your job or any job? That's what we call the own occupation definition, or an any occupation definition. It would be very different for, let's say, a client of ours who's a surgeon. If he breaks his hand, certainly he can do other work, but he can't do his same work, and certainly not to the fullest extent. And so that definition of disability is very, very important. Frank, if you have anything you'd like to add on that.
So a couple things I want to add on. So typically, if short-term disability is offered, and not every employer offers short-term disability, there's usually what they call a coordination of benefits. So wherever the short-term disability period is, say it's 90 days or it's 120 days, if you're still on disability, the coverages will coordinate onto your long-term disability program. That's how that is handled. Keep in mind that both short-term and long-term disability, we as a firm look at it as more catastrophic. Chelsea started pointing out some of the limitations on long-term disability. First of all, if it's offered, you should take it. Other limitations, they will say, well, we coordinate and we'll help you get your Social Security benefits. Well, the reason why the insurance company states that is, if they can get Social Security to cover your disability, they won't have to cover your disability. So the insurance company is very much incentivized to have you qualify for Social Security disability, which actually is very, very, very hard. Typically, there's a mental nervous disorder. If you go out for mental nervous disorder, there's a limited benefit period, maybe a year, maybe 2 years, where a lot of the privately bought disability programs offer a longer benefit period. So again, you heard me say earlier that the cost of the insurance is usually related to how much risk and benefit that the plan is going to pay. Really, the cost of long-term disability is not a lot. They usually cover 60% of your pay. Some employers offer a buy-up to 70%. You're not going to get any higher than that. Again, they want you to go back to work. So if they're going to cover 100% of your pay, there's no incentive to get back to work right away. But you have to remember these benefits are taxable. So say you get a 60% benefit and you are out on claim, right? Now 60% is probably below what your take-home pay. Most likely it is. Now that 60% benefit is going to get taxed. It's going to drop your take-home to probably about 45%. So the challenge for most people is, can they survive a long period of time on 45% of their pay? So in those cases where someone might be concerned about that, you can buy supplemental individual disability, which we've done. Now it's not going to sound right, but usually it's your white collar jobs that you can buy supplemental disability on, and they will basically cover the gap between that 45% number and potentially that 70% number. So at least you're getting closer to 60 to 70% of your take-home pay to get by. And usually the definitions are a lot better, benefit periods are a lot better, but it's more costly. So that's the trade-off. So you have to look at your risk profile and say, all right, do I really want to self-insure myself if I'm disabled, or do I want to transfer the risk to an insurance company? Unfortunately, if you're a blue-collar worker, even if you're in the trades, if you're part of a union, you're going to have benefits on disability. But if you're not, it's really difficult to get blue-collar workers coverage because, unfortunately, the high incident rate of getting hurt, the insurance companies just don't want to touch it. I would liken it to if you have a home on the beach in Florida. It's very difficult to get homeowners insurance for coverages. That's why the governments, like in California and Florida, are stepping in. The insurance companies just don't want to touch it. So we're just trying to really tell you like it is.
That's a really good point. On that note, too, as women, we have a pretty high mortality rate. We tend to live a long time, but we don't have as high morbidity rates. Morbidity rates being what underwriters of disability plans are looking at it as far as a woman's risk of getting a long-term sickness or injury. So to all our women listeners, if you have the option to take long-term disability through work, absolutely take it. And then we encourage all of our clients, those in the medical field especially, looking at ways they can maximize their policy.
As well.
Executives, yeah. Yep, maximizing those policy definitions to make sure it really covers what you want it to. But the most important piece is, especially if you have two working spouses, is to connect with your advisor and have them run a stress test for you and see just what you really need and what that impact would be to your financial plan, short-term and long-term, if one of you is sick or hurt for a while.
Great. So we have two last insurance ones that shouldn't take quite as long. The second last one is life insurance. Most companies offer some form of group life insurance. Part of it could be in tandem with your medical coverage. It's usually not a lot. It's somewhere between $5,000 and $50,000. It's a typical benefit. The employer can pay up to $50,000 of life insurance, and you don't receive any inclusion of that benefit of the premium in your paycheck. However, if the employer pays for anything more than that, the value of that benefit, whatever that premium is, will be included in your pay. Now, the benefit for that is you want your life insurance to be tax-free, because usually when you pass away, there's a large amount of money coming into the family in that tax year, and it's going to put you most likely in the higher tax brackets. And so a lot of that life insurance that you might be counting on is going to be taxed. Typically, when we look at coverages for our clients, if you're healthy, you're usually better off buying insurance, life insurance, term insurance, I should say, because this is really, in most cases, term insurance. We usually recommend you buying the insurance on your own. You can get a better deal. The group insurance, if you have higher risk, like you're diabetic, you're vastly overweight, you have medical issues, you're probably not going to get good underwriting in an individual policy, so you're better off taking whatever you can take from the company from an insurance plan standpoint, because you're put in a basket with everybody and there's no underwriting. So if you're a smoker and diabetic, they have to take you just like if there's someone who can run the Boston Marathon and is totally healthy, they're all going to be pooled together. So you have what they call a blended rate, and that's what I'm saying. If you're healthy and young, or even healthy and older, you're probably better off. Typically with group life insurance, it's not portable, so you have to be mindful if you ever leave your employer, you might have a change of life insurance at the other employer that might not be as good. And if you have health issues and your coverage is automatically lowered, that's a risk that you might have to take on. Some plans offer portability, which means that if you leave, you can take the plan with you. But keep in mind though, as I said earlier, all group plans, the blended rate tends to be higher than if you compare it to a healthy individual. So if you're unhealthy and you have a portable plan, I'm probably going to lean towards you taking it with you, versus if you're younger and healthy or just healthy in general, we're going to probably recommend you buy your own plan, because you can get longer term limits. You can also get conversion rights. Very few group plans allow you to convert to what they call a cash-based or permanent life insurance. You'll know names like whole life insurance, variable universal life insurance, or universal life insurance. They offer some of that convertibility, but again, it's going to be converted at a higher risk rate. But typically, again, it's going to be people that are already in a risk class that's higher anyway. So it might make sense to consider that if you have conversion options. So again, I think the general rule is if you're healthy, you should probably buy your life insurance on your own and get better rates, better coverage, better conversion rates. If you're not healthy, you're better off just going through your employer and taking what you can get to the extent that that's what you need for your planning. Anything you want to add, Chelsea?
The only other notes I have is something that we'll have clients ask us about is accidental death and dismemberment insurance, and and even sometimes I'll see employers offering specific cancer insurance and things like that. Really, the more narrow or specific an insurance contract gets, usually the tougher that is to pay out. So while I don't want to necessarily dissuade anyone from looking into that, an accidental death or dismemberment is usually going to be looking for what I would call a final destination type scenario, where it's a pretty freak accident type of situation. It's not a bad thing to tack on, but if there's an option to get more, to add more to it, it's usually not something I would encourage clients to seek out.
Yeah. Well, I would put it this way: if you work from home, probably not as much of a need. If you travel a lot, you fly, you drive because of your job, or you're in positions where your risk rate goes up to potentially die, we would lean towards that. Maybe you want to consider it. So again, this is an individual choice. You got to look at your situation. And again, none of us have crystal balls on that. So last insurance we'll cover real quick, and then we're going to talk about retirement plans, is dental insurance. I know it's not a sexy topic, but usually dental's offered, and vision, they usually offer jointly. So do you want to add some comments to that?
Nothing in particular, other than you really just have to have a good understanding of your needs, of your family's current needs, some basics that you might want covered each year. I think it would be fair to say basic checkups and things like that. That HSA can certainly help with filling in some of those gaps there, with any of those expenses where if you don't have a super competitive dental or vision policy, that might be able to help.
Yeah. Again, a couple things to keep in mind, especially age is a factor. But if I'm young and I've never had a cavity and I'm meticulous about flossing and brushing my teeth, you can talk to your dentist and say, well, listen, if I private pay, what is my cost? Because usually what they charge insurance companies is higher because the reimbursement rate is different. And so the premium that the cost to go get a cleaning, if you pay out of pocket versus if you go through insurance, is different. So if you're young and you really don't have issues with eyes, like I don't need glasses or contacts, I'm 22 years old, and I got great teeth, paying that premium, you probably might be better off just paying out of pocket. So, but the way you do that is you talk to your vision doctor and say, okay, if I need a checkup, what does it cost me to private pay? So you got to make sure you ask them, what does it cost for private pay? They will tell you that, and then you compare it to what the insurance premium is, and you might find it's just cheaper to private pay than to pay the insurance company. Now if you got always had bad teeth because it's a genetic issue, and you wear Coke glasses for glasses, you're probably better off having the insurance coverages. So again, you have to look at your health and your situation when you make these individual elections.
Well said.
Yeah, thanks. So the last topic is the 401k plan, and it's definitely gotten a little more challenging in a good way because there's more options in 401k plans today than there were like 10 years ago. So, and again, lean on you first, Chelsea, to talk about 401k plans and some of the different things that employees need to consider.
Yeah, I think the very first thing that you should consider, especially if you're starting a new job, is understanding your enrollment period and when you can enter the plan. That's certainly something that you don't want to miss. Now, more and more employers are offering automatic enrollment where you're in the plan and you just have to elect to opt out. With the 401k, similar to an HSA, but still not at that triple tax efficiency. With a 401k, of course, you've got your salary deferrals become your tax-deductible contributions to the plan, and then it gets to grow tax deferred, and then you pay income tax when you take the money out. Understanding what type of plan there is, for example, if it's just a straight 401k option, or if there's a Roth component to it, and then understanding if you're tilting more toward the Roth side, what that might mean for you tax-wise. A lot of that really depends on your belief in where taxes might go for you, and for your situation, both short-term and long-term. If you believe you may be taxed more today than you will be in the future. So that's kind of what you want to look at first, is how you're dividing up among pre-tax and tax-free contributions. And then, of course, deciding what that contribution amount is. We always encourage our clients to look at that employer match and hit or exceed it within their budget. If there's money on the table, you take it. There are some new, I was reading as far as the contribution limits, those were just released, I think. For next year it'll be $23,500 for people under 50 with catch-up contributions available. They've actually tacked on just an additional one for those 62 to 65, I believe, which gives you the ability to contribute even more so into the 401k just for that chunk of time. But it's never too late to maximize those retirement savings, and it's really important. I'll circle back to the contribution piece in a moment to have you speak on that, Frank. But something else I think that's very crucial, and Frank, you can probably talk about this too, is deciding how to invest your 401k. There's a lot of default options, but there can be a certain benefit to planning out what you invest.
So I want to reiterate a very important planning point Chelsea brought up is, do I use the traditional 401k plan versus the 401k Roth? People just assume, Roth, I pay tax today and I don't pay tax tomorrow. This is really always a tax question, and you need to revisit it. Especially with life events, or life event could be you get a big raise, or you get married and now your household income is higher. So really you need to look at what is the marginal tax rate that you're paying. So the low end today is roughly 10%. And as Chelsea pointed out, if I retire and I'm in a higher tax bracket, putting money into a Roth is a way better option to go. But now I'm maturing in my career. I get married at 35. My spouse has a nice earnings as well, and our household income is up. And now we're at the 24% tax bracket. Well, I might want to start thinking about tax deductible, because if in retirement I'm in a lower tax bracket, that means I'm not paying tax at a high point in my life, and in a lower point in my life when I'm not working, I'm paying less tax. I win. It's really tax arbitrage. It gets tougher when you're in that 20, where most Americans are that are paying taxes. When you're in that 22, 24 marginal bracket, obviously Chelsea or I or no one knows, I don't even think the new president knows, what tax brackets are going to be 20, 30 years from now when I start taking money out. So sometimes you do a hedge strategy, where I put some of the money into the tax-deductible 401k plan, and then I put it into the non-deductible Roth, so I have a couple buckets to choose from when in retirement. Because when you're in retirement, you go from an accumulation strategy, which is easy. I save as much as I can. When I'm retiring, I have money coming out to me. I might have a pension, I have Social Security, I have an IRA, I have a Roth. So I have different places I can take money that can influence my tax bracket. So it really is a tax question. If I had a general rule, usually if you're single and you're just starting out in a lower tax bracket, most likely you're going to probably be better off as a Roth. If you're in a high income bracket, you're probably better off in a traditional. Budget becomes an issue, especially for those younger folks. Key thing, if your employer is matching you, defer if you can. Do whatever you can to defer up to the point you can get the match. It's free money. We're great investment advisors here, but I can't generate 100% return on your money usually in a year. And if someone's giving me a dollar for dollar match on what I'm putting in, you should take that. You also should be aware that there are different types of plans out there that have automatic enrollment, so that you automatically enrolled. So if you're going to a new company, you have to ask, am I automatically going to be enrolled? Is there these things called auto escalate, where the company might auto escalate you? So if you're deferring at 3%, every year they're going to automatically increase you by 1% up to a cap unless you say no. Now, the reason why they do that is the theory is as you get raises, you should be trying to save more. And a lot of people, quite candidly, get lazy. They forget to change their elections and their contributions and all that. So the company's trying to make it easy by offering you, the auto escalate. So make sure you're familiar with the options. As it comes to investing, most plans offer individual investment options, and then the most popular option out there is these target date funds. I would call them a glide path. So if you can think of a plane flying very high, and then as you get closer to retirement, it's going to land, that's how the investments are designed. So you take a lot of risk early on, and as you get towards retirement, the portfolio becomes less risky. Now, in theory, that sounds great. But there's some misconceptions about that. Just because I'm young doesn't mean I'm comfortable with risk. My two daughters are much more conservative than me at that same age. So there's a risk alignment, and the reason why I bring that up is that usually people make poor investment decisions when the market doesn't do well. And what we don't want, and probably the fastest way to kill your portfolio performance over time, is constantly making changes at the wrong time. The other potential misstep is when you do financial planning, and Chelsea raised a good point, that you need to really factor how you're planning for your family. When I go to retire, I might need my portfolio to generate, let's just say, 7% rate of return. Just, for the factors, to keep it simple today. Well, if the glide path sets in at 6%, and that might be fine given that portfolio, you're misaligned. You're 1% off on what your financial plan needs. So we find that the benefit of, hey, I don't have to do anything, and putting into a glide path might make sense. There's some inherent risks if you're really not paying attention to your planning, and you could miss the boat. So we tend to advocate designing a portfolio that fits your financial plan. And then if you don't like managing your plan and rebalancing, a lot of these companies offer automatic rebalancing. So you can rebalance once a year, once a quarter, once a month. We would say twice a year is probably what we would recommend. Quarterly tends to be too much. There's a lot of science behind that. So I would say if you could rebalance twice a year or at least once a year, then you don't have to worry about going in yourself and reallocating amongst your investments. And if you're working with a financial advisor, your financial advisor should be guiding you on how to, and this is another advanced planning technique, it's called asset location. Think about your stock portfolios. They tend to be taxed at capital gains rates, which are much lower than your ordinary income rates. Well, if I'm buying, and you might not have an option. If you're only saving in your 401k plan, you're not going to probably have this flexibility. But if I have money outside of my investing and I'm putting money in the plan, I want to keep my capital gain assets outside of the 401k plan if it's a traditional IRA. And the reason is when money comes out of your traditional IRA, it gets taxed at ordinary income rates. So inherently, I'm taking a capital gain asset that's taxed at a lower rate, throwing it into my traditional IRA, and I emphasize traditional IRA because this doesn't apply for a Roth. And then I'm converting it to ordinary income. So for those that have more significant balances, so you're probably a little older, you have monies on the outside, you're going to want to make sure you segregate your assets so you don't change the income tax properties of the investments. If you're younger, like my daughter, all she's putting in is in her retirement plan. Like as I said earlier, she's in a low tax bracket, so I'm having her go into a Roth. It doesn't even apply. So this only matters if you're doing the traditional IRA or the simple IRA where it's tax deductible, that you should at least be asking your question, can I do some asset location to further lower my tax drag? Keep in mind you're allowed to borrow out of your 401k plan. Most plans allow it, and they also have distributions in case of certain emergencies, what they call hardship distributions. Hardships are different. I really don't like employees using their 401k plan as an ATM and always borrowing out, because even though you're paying the interest back to yourself, you're really taking your money out of motion and working for you. So really try to commit to a savings strategy and let the money work for you. Einstein always said the eighth wonder of the world is the compound interest rate. So allow your money to compound for you. Any other thoughts on retirement plans?
No, nothing to add really. It's always important to make sure that you're coordinating it with your overall financial plan.
Yeah. Number one, your investment planning is a subset of your financial plan. So make sure, as Chelsea pointed out, your financial plan is your guiding compass on what decisions you need to make. So with that, I want to thank everyone for being here today, listening. Hopefully they got a lot out of it. I want to give you a heartfelt gratitude to all of you for the upcoming Thanksgiving with your families and friends. God bless. And if you like what you hear, please remember to subscribe to Frank Wealth Insights as your podcast on one of your favorite platforms. Tell friends about it. And if you do have any questions, please contact us at 877-514-9991 or visit our website at returnonlifewealth.com. Thank you again.
This has been Frank Wealth Insights, the financial and investment podcast from Return on Life Wealth Partners. Your life, your money, your way. Experience financial planning the way it should be, not the way they want it. See how at returnonlifewealth.com. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax situation with a qualified tax advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This communication expresses the views and opinions of the participants as of the date it was recorded or indicated, and such views are subject to change without notice. This podcast is being made available for educational purposes only and should not be confused for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. This podcast may discuss forward-looking statements that are based on then current beliefs of the participants. Investment advice offered through Planned Financial Services, a registered investment advisor.